There's a law in finance that no government can repeal, no innovation can escape, and no civilization has ever broken. It's not written in textbooks or carved into stone, yet it governs every market and every empire that ever dreamed it was smarter than mathematics. The law is simple. What is borrowed must be paid, and what is leveraged will one day unwind. In the early stages, this law hides behind prosperity. It whispers rather than roars. Economists call it growth, politicians call it progress, and investors call it a new era. But behind the optimism, the numbers begin to curve upward in the same familiar pattern. Credit expands faster than income asset prices, rise faster than productivity, and confidence expands faster than reason. It happened in 1929 when leverage disguised as prosperity turned Wall Street into a cathedral built on debt. It happened again in 1989 when Japan's real estate and stock markets reached divine valuations that no earthly economy could sustain. And it happened once more in 2008 when a mountain of mortgage derivatives nearly buried the global financial system. Each time the story began with the same illusion that humanity had evolved past the old limits, that regulation technology or intelligence had finally conquered risk, that this time the system was different. They were wrong every time, because what destroys financial systems isn't politics or war, it's arithmetic. It's the inescapable equation that governs every bubble when debt grows faster than output collapse. Isn't an event, it's an outcome waiting for a trigger. Now in 2025, that equation has returned. All 7 variables of the historic pattern, easy credit, speculative fever, insider exit, new era delusion, and the coming cascade are in alignment once again. We're standing inside the same mathematical tunnel that swallowed 1929, 1989, and 2008. The names are different. The assets are digital. The screens are brighter. But the law hasn't changed. You don't need to be a prophet to see what's coming. You only need to recognize the pattern, because once you see it, you can't unsee it. And the first truth to accept is this: the next collapse won't be random, it will be earned. Every great financial illusion begins with a noble intention. The system breaks not because leaders are evil, but because they believe they can outsmart gravity. In 1921, America had just emerged from a brief post-war depression. The Federal Reserve, still a young institution, cut rates to stimulate recovery. Money became cheap credit abundant and confidence infinite. By 1925, people called it a new American century. Factories boomed, cities grew, and the middle class discovered installment payments, a way to own everything now and pay later. Fast forward a century. After the 2008 crash and then the COVID-19 pandemic, global central banks followed the same playbook, but on a scale that would have terrified even 1920s bankers. The Federal Reserve printed over $8 trillion. Europe, Japan, and China flooded the world with liquidity. Interest rates fell to zero, for a while below zero. The result, an economy on life support that felt euphoric. Markets surged, not because companies were creating more value, but because money was free. Mortgages, student loans, and corporate bonds multiplied. Trillions flowed into assets that were never meant to be stores of wealth. Meme stocks, crypto tokens, NFTs, even digital land in virtual worlds. Cheap money made everyone a genius, everyone rich on paper. But here's what history shows: when credit becomes nearly free, human behavior changes. Why save when borrowing is effortless? Why build something slowly when speculation pays faster? Why invest in factories when leverage doubles your money in months? The economy shifts quietly but completely, from production to speculation, from saving to borrowing, from patience to greed. It happened in 1925 when the Dow began its silent climb. It happened in 2021 when everything from houses to JPEGs became investment assets. And in both eras, people mistook borrowed prosperity for real wealth. By 2025, the system is addicted to the drug of cheap credit. Governments can't stop printing. Corporations can't survive without debt. Consumers can't function without revolving credit cards. The machine runs beautifully until one gear slips, because easy money doesn't build foundations. It builds illusions. And illusions like leverage always expire on schedule. Speculation is the moment when money stops serving the economy and the economy begins serving money. In every bubble, there comes a phase when people stop asking, what does this company produce, and start asking, how fast is it going up? That's when capitalism mutates into a casino. In the late 1920s, it was the ticker tape rooms of Wall Street, crowded smoky, alive with the sound of typewriters, spitting out fortunes by the minute. Clerks shouted prices as ordinary Americans watched their stocks climb on credit. The language of production gave way to the language of excitement tips, hot stocks, inside info. A century later, the rooms are digital. The ticker is an app. Reddit threads replace the trading floor. Robinhood replaces the broker. The emotion is identical, the same dopamine, the same frenzy, the same belief that we've discovered a secret path to effortless wealth. During the pandemic, millions opened trading accounts. Meme stocks like GameStop and AMC became battle flags of rebellion. Cryptocurrencies turned college students into overnight millionaires. NFTs, digital images without intrinsic value, sold for millions. Everyone felt brilliant. Everyone was a financial visionary. But speculation always begins as entertainment and ends as ruin. In 1928, buying stocks on margin was considered smart. In 2024, using 20x leverage on crypto futures was innovative. The mechanics are identical: borrow to buy, watch it rise, believe you're gifted, and ignore the arithmetic that says a 10% drop erases you completely. What changes isn't the mathematics. What changes is the story. Back then, it was the new machine age. Today, it's AI blockchain disruption. Each generation finds its own mythology to justify the same addiction, gambling dressed as investment risk disguised as genius. And beneath it all, leverage builds silently, hidden in brokerage accounts, corporate balance sheets, and shadow banking systems, invisible until it's not. Because speculation doesn't just distort prices, it distorts perception. When the crowd believes they can only win, they forget that winning requires someone else to lose. That's the paradox of stage 2. When everyone's a genius, the crash is already scheduled. Every mania has its exodus, a moment when the ones who built the fire begin walking quietly toward the door. In 1929, Joseph Kennedy sold out months before the crash. The story says he decided after his shoeshine boy started giving him stock tips. If everyone's an expert, he thought, there's no one left to buy. But it wasn't intuition, it was arithmetic. Kennedy understood leverage. He knew when 90% of purchases are made on borrowed money, a 10% fall means forced liquidation. He knew the math would devour the market. The same pattern is unfolding now. In 2025, the names have changed, but the behavior hasn't. Warren Buffett holds over $325 billion in cash, Berkshire Hathaway's largest hoard in history. Hedge funds quietly rotate into short positions. The largest institutional investors, BlackRock, Vanguard, State Street, are rebalancing away from risk assets while telling retail investors to stay the course. Insiders are selling, not trimming, unloading. In 1929, it was industrial magnates. In 2025, it's tech executives cashing out millions in stock options while publicly tweeting optimism. It's CEOs smiling on CNBC while their legal disclosures show steady liquidation. They know what the crowd doesn't, that corporate earnings are stagnating while valuations soar, that margins are eroding under hidden inflation, that the mathematics of compounding debt can't defy gravity forever. And the volume tells the story. High volume isn't confidence, it's distribution. When institutions sell, they need someone to buy. The crowd becomes liquidity. The crowd becomes the exit. On the surface, the market still shines. The charts still climb. Analysts still publish price targets that rise as fast as the stocks themselves. But beneath the surface, the professionals are quietly unplugging their profits and walking away from the table. Because in every cycle, there's a point where the smart money stops chasing returns and starts counting exits. They don't ring bells at the top. They whisper. They sell to believers. They smile as they do it. Stage 3 isn't panic, it's preparation. It's the silence before the sirens. And once the doors close, the crowd won't know it's over until the floor disappears beneath them. Every bubble ends the same way, not with fear, but with faith. By 1929, investors weren't just optimistic. They were evangelists. Newspapers printed headlines declaring a new era of prosperity. The brightest economist of the time, Irving Fisher, stood before Yale and said, "Stock prices have reached what looks like a permanently high plateau." That sentence became his epitaph. The same religion of progress is alive today. In 2025, it wears new robes: AI, green tech, digital transformation, Web3, the metaverse. The slogans have changed, but the message is identical. This time is different. Analysts on television speak of valuation re-rating. Central bankers talk of soft landings. Influencers post from yachts saying anyone who holds cash is missing the future. It's the same intoxication, the same blindness wrapped in new buzzwords. And just like 1929, there's truth mixed into the delusion. Yes, technology is advancing. Yes, productivity is real. But markets don't collapse because innovation stops. They collapse because valuations detach from reality. When price becomes its own justification, reason dies. When people say it's expensive because it's the future, they forget that the future still has to pay interest. Every bubble invents its profits. In the 1920s, it was the radio and the automobile. In the 2000s, it was the internet. Today, it's artificial intelligence, the invisible force that supposedly guarantees eternal growth. The narrative is seductive algorithms will replace workers, robots will print profits, and human limitation will vanish into code. It feels unstoppable, inevitable, divine. But the market doesn't trade in dreams. It trades in cash flow. And no dream, no matter how luminous, can outlast the mathematics of leverage. By mid-2025, valuations have reached absurdity. Companies losing billions are worth hundreds of billions. Cryptocurrencies soar without utility. Venture funds raise money to buy tokens they invented themselves. It's not capitalism anymore, it's a mirror maze built from optimism. And in every mirror maze, the same thing happens. The crowd runs forward until it smashes, face first, into its own reflection. That's stage 4, the peak of belief, the death of skepticism, and the moment before gravity reminds everyone that faith doesn't pay margin calls. Crashes never begin as crashes. They begin as whispers, a few strange headlines, a few red candles on a chart, a quiet unease that spreads faster than reason can contain it. In October 1929, it started with selling that looked technical. Brokers said it was profit-taking. Newspapers called it healthy correction. By the time anyone realized it wasn't, the floor had already vanished. Now, nearly a century later, the pattern returns, only faster, colder, and fully automated. It begins in silence. A tech stock misses earnings by a fraction. A major crypto exchange halts withdrawals. A regional bank quietly collapses after an unexpected liquidity event. None of it feels like history. Not yet. But behind the screens, algorithms begin to calculate risk exposure. Positions linked by trillions in leverage start unwinding. The invisible chain connecting hedge funds, pension portfolios, ETFs, and retail margin accounts begins to tighten one automated margin call at a time. In 1929, brokers sent letters by mail. In 2025, liquidation is instant. A 5% dip triggers stop losses. A 10% dip triggers forced sales. At 15%, the machines panic. Across exchanges, liquidity evaporates in seconds. AI trading bots designed to react faster than fear dump billions in assets simultaneously. The indexes gap down so violently that circuit breakers trip before traders can blink. And as prices free fall, panic becomes policy. Central banks announce emergency lending programs. Politicians hold late-night press conferences assuring the public that the fundamentals remain strong. But fundamentals mean nothing when everyone is a forced seller. This is the mathematics of destruction, the same equation that ruled 1929. When assets fall below debt collateral value, liquidation isn't a choice. It's a command. Margin calls cascade like dominoes. Hedge funds implode overnight. Banks scramble to cover shortfalls. Then come the withdrawals, billions pulled from money markets, digital bank runs racing through apps faster than any teller line in history. By day 3, global markets are synchronized in collapse. Tokyo, Frankfurt, London, all down double digits. Bitcoin plunges 70% in a week. Real estate funds freeze withdrawals. The illusion of liquidity is exposed as the oldest truth in finance. You can't sell what everyone owns at once. And then comes the second wave, the real economy. Factories halt production as credit lines vanish. Companies slash payrolls. Unemployment jumps in weeks, not months. Consumers stop spending, causing more layoffs, more defaults, more panic. This is stage 6, the cascade, when financial destruction infects the real world. Prices fall, debts don't. That's deflation, when the value of money rises but nobody has any. Mortgages grow heavier as house values collapse. Businesses drown under fixed loans. Families liquidate savings to survive, feeding the deflationary spiral even further. In 1930, it took 3 years for the Dow to lose 89%. In 2025, it could take 3 weeks. Because the system no longer breathes, it reacts. It's digital leveraged and hypersensitive. And when mathematics turns against it, there are no circuit breakers strong enough to stop the logic of debt from finishing its work. The crash doesn't announce itself. It simply arrives first as data, then as disbelief, then as despair. And when the silence finally returns, the illusion that once powered an empire of optimism will have turned to dust. When the dust finally settles, the silence feels unnatural, like the world has been turned down to half volume. Screens stop flashing. The anchors on television sound dazed. Politicians call it a correction. Economists call it a rebalancing. But ordinary people know the truth: something broke and it's not coming back. Stage 7 isn't chaos. It's emptiness. The market has already done its work, purging leverage, erasing illusions, resetting the scoreboard of greed. What remains is the reckoning. In 1933, that reckoning meant breadlines and bankruptcies, but also rebirth a generation that rebuilt America's financial architecture from the ruins. Deposit insurance securities regulation, fiscal oversight, the systems that still protect us today were born from failure. The same choice now stands before us. The 2025 collapse will not destroy civilization, but it will destroy complacency. The age of infinite credit and zero consequence is over. We are entering the age of accountability, where numbers matter again, where saving means survival, and where speculation without purpose will no longer be rewarded. But there is another side to this story, a quieter, more personal one, because while governments debate bailouts and central banks rewrite policy, individual lives must go on. Families will tighten budgets. Entrepreneurs will build smaller but stronger. Investors who learned humility will become the next generation of leaders. History's message is merciless but fair. Every collapse is a cleansing. Every ending is an audit of values. And if you understand that, then you'll understand the final law that wealth isn't what you keep in the market. It's what you keep in your mind when the market burns. So when you see headlines scream, panic, remember, the mathematics doesn't hate you. It's just neutral. It punishes excess and rewards discipline. It breaks those who borrow from tomorrow and strengthens those who build for it. The crash, when it comes, won't be your fault, but surviving it, learning from it, that will be your responsibility. And maybe when the next generation studies the charts of 2025, they'll see what we couldn't, that in the ashes of one illusion, a new reality was born, one built not on leverage, but on truth.